Have you ever stared at a company's success story? Maybe, a startup that just exploded, or an established giant that keeps innovating, and wondered, how do they actually do it?
Mm.
Like, beyond the shiny new product or the impressive sales figures, how do they really know if they're moving the needle in the right direction? Well, you're in luck, because today we're taking a deep dive into performance management. This is really the art and science of how organizations measure, understand, and ultimately, hopefully, improve what they do. Our mission today is to cut through the jargon, unpack this fascinating world of performance metrics, everything from the obvious financial figures to the less obvious, but honestly equally crucial, non-financial indicators. And we want to show you how they all connect to drive real outcomes. We've sifted through a stack of sources to extract the most important nuggets of knowledge and insight for you. Think of it as a serious shortcut to being well-informed. So whether you're prepping for a big meeting, exploring a new industry, or maybe you're just insanely curious about how businesses truly tick, this deep dive is definitely for you. Okay, let's unpack this then. At its heart, performance management feels like it's about so much more than just crunching numbers on a spreadsheet, isn't it? It seems, fundamentally, it's about human behavior, motivation.
It absolutely is, yeah. At its most fundamental level, performance measures are ultimately designed to provide feedback. And this isn't just, feedback for reporting upwards or for simply ticking boxes on some checklist. The core purpose really is to motivate appropriate employee behaviors. Think about it like this. If you want someone to act in a specific way, you need to clearly communicate how they're doing in relation to that desired action. And crucially, you need to show them how that behavior ultimately benefits them. That's really why feedback that's tied directly to an individual's self-interest is almost always the most effective. When employees can see a clear, direct connection between their actions, the performance measures being used, and their own personal incentives or, professional goals, they are far more likely to align their behavior with the organization's overarching objectives.
Okay, so it's not enough to just measure something. You're saying you need to strategically link the measurement to the incentive and then link that incentive to the overall goal. Wow, that sounds like an incredibly delicate balance. What's the most common pitfall companies fall into when trying to link those three? And maybe more importantly, how can they avoid those unintended consequences?
That's a crucial question because it's definitely a delicate balance. The critical issue with any performance measurement system is ensuring the appropriate linkage. That linkage between the measures you choose, the incentives you provide, and the overarching goals of the organization. The biggest pitfall, and honestly we see this all the time, is when these three elements become misaligned. If that happens, you inevitably end up with unintended and often quite counterproductive consequences. Let me give you a classic example. Imagine a company whose ultimate goal is to maximize profitability. That's the big goal. But let's say they choose to measure performance purely by sales volume, and they incentivize their sales team based solely on how many units they move. What often happens? Well, employees might start pushing products that aren't very profitable, or maybe offering deep discounts that just erode margins, all just to hit their sales numbers and earn their bonus. See the disconnect? The goal was profit, the measure was sales volume, and the incentive was a sales bonus tied only to volume. That linkage is broken. The surprising nugget here, I think, is that you can measure all day long, but if that measurement isn't tied to a clear goal and an incentive that makes sense to the person doing the work, you're not managing performance, you're just generating data. You're essentially telling your team to drive somewhere, but you're giving them directions to a completely different destination. It doesn't work. Now, broadly speaking, these performance measures fall into two main categories. First, there are financial measures. These are the numbers you're probably most familiar with. They're typically calculated directly from generally accepted accounting principles or GAAP financial statements. Sometimes they come from non-GAAP financial reports, which, adjust those GAAP numbers for specific insights. Common examples here include things like benchmarking, which we'll definitely dig into various financial scorecards, and even something called costs of quality. The second category is non-financial measures. Now, these are distinct because they do not directly tie back to financial statement numbers. However, they provide other incredibly crucial means of assessing performance. You'll find these are becoming increasingly important in modern business, especially as companies realize that things like customer satisfaction or employee engagement or even process efficiency can be just as vital to long-term sustainable success as the traditional financial bottom line.
Right. So if we want to figure out how our business, let's call our hypothetical company, Innovate Flow Solutions, is truly doing, it sounds like one of the first places to look might be outside our own walls or maybe even deep inside our own operations. Is that where benchmarking comes in, as a way to intelligently analyze ourselves against others?
Precisely, yeah. Benchmarking is essentially a systematic process. It's about measuring your own processes, your products, your services, against those of industry leaders, or sometimes even just top performers within your own organization. It's really about identifying what the best are doing and then figuring out how you can adapt, learn, and improve based on their successes. It's not just about copying, though. It's about strategic understanding, learning the why behind their success. Organizations typically engage in, well, three primary categories of benchmarking. One is process benchmarking. This really digs into how things are done. You're comparing your specific operational processes, maybe within Innovate Flow, to those of leading companies. It's all about efficiency and methodology, literally comparing step-by-step workflows, trying to find smarter ways to do things. Then, sort of broadening that view, we have strategic benchmarking. This is a much wider comparison. Here you're looking at the different business model and overall strategic approaches of other organizations. The goal is to strengthen your own long-term strategies by understanding how others compete and create value in the market. It's less about a specific task, more about the fundamental approach. And finally, if you just want to compare results, there's what's called functional performance benchmarking. This type focuses purely on outcomes, what was achieved. You're comparing hard results, things like defect rates, delivery times, customer satisfaction scores, without necessarily delving deep into the underlying processes or strategies that led to those outcomes. It's really about comparing the what, not always the how. Okay. And importantly, these benchmarks can be both external looking at other companies and internal looking within your own organization. Let's start by looking outside first.
All right, so external benchmarking means Innovate Flow is looking beyond its own four walls. Makes sense? What are we trying to achieve by doing that specifically? And what exactly do we compare? Are we just looking at profit margins?
Good question. The primary goal of external benchmarking is really to analyze how your specific business, Innovate Flow in this case, compares to others in its industry. The aim is twofold. Understand where Innovate Flow might fall short compared to competitors or industry best practices. And then, more importantly, figure out what specific actions you can take to do better. This involves a pretty comprehensive look at various aspects of competitors. Yes, financial ratios, but also their products and services, their marketing efforts, other operational efficiencies. By examining all these areas, you can often uncover significant opportunities for improvement within your own company. Now, a key aspect of external benchmarking, particularly when you're looking at efficiency, involves productivity ratios. Productivity itself is simply a measure of the ratio of the outputs achieved to the inputs of production. In essence, it's a direct measure of efficiency. How much bang are you getting for your buck, so to speak? It uses relationships derived from actual performance, often in comparison to similar organizations or maybe just your own historical data over time. The surprising insight here, I think, is that productivity isn't just about how fast you work, but how efficiently you use everything, your materials, your labor, your capital, all of it. There are two main types of these productivity ratios that are generally recognized. The first are total factor productivity ratios, or TFPs. These reflect the quantity of all output produced relative to the costs of all inputs used. So everything together. This ratio gives you a comprehensive view of overall efficiency. It can be used to compare your actual cost per unit production levels to budgeted levels or even prior year's levels. It's a holistic measure, really, of how effectively you're converting all your resources into output. Then we have partial productivity ratios, or PPRs. Now, unlike TFPs, PPRs reflect the quantity of output produced relative to the quantity of individual input used. So instead of looking at all costs, you might just look at output per pound of material, or maybe output per labor hour, much more specific. This ratio is specifically used to compare the actual levels of production input needed to produce a given output again, often for comparison with a budget or a prior year's input level. What's significant about PPRs and why you see them so much is that they are the most frequently used productivity measure. Why? Because they allow for that more granular analysis of specific inputs.
That makes a lot of sense. Yeah, it's easier to pinpoint an issue if you're just looking at one input rather than everything mixed together. Can you give us an example to really bring this to life? Maybe for a company like Garden Furnishings, Inc. That sounds interesting.
Absolutely. Let's consider Garden Furnishings, Inc. They produce high-end outdoor garden sculptures. It's a pretty niche market. Let's say each sculpture uses two main raw materials, plastic and cement, with plastic being the largest input by weight. Okay, so let's say during a particular month, Garden Furnishings used 20,000 pounds of plastic and 5,000 pounds of cement to produce exactly 1,000 garden sculptures. We also need the costs. Let's say plastic costs $1.25 per pound and cement costs $1.75 per pound. Now let's calculate the partial productivity ratio, the PPR, just for plastic. Remember, we're looking at the quantity of output produced per quantity of input used. So for plastic, that's 1,000 sculptures divided by 20,000 pounds of plastic. This gives us 0.05 sculpture units per pound of plastic. Okay, what does this number tell us in practical terms? Well, it means that for every pound of plastic used, the company produces 5/100ths of a garden sculpture. Or maybe an easier way to visualize it, flip it around. It means it takes 20 pounds of plastic, 1 divided by 0.05, to make one sculpture. This directly measures the efficiency of their plastic usage. Now, for the total factor productivity ratio, the TFP. Here we need to consider the cost of all the inputs. The plastic cost was 20,000 pounds times $1.25 per pound, which is $25,000. The cement cost was 5,000 pounds times $1.75 per pound, which is $8,750. So the total input cost was $25,000 plus $8,750, which equals $33,750. The TFP would then be the output, 1,000 garden sculptures, divided by that total input cost, $33,750. That comes out to approximately 0.02963 units of output per dollar of input cost. This consolidated efficiency measure tells us how many sculptures are produced for every single dollar spent on all raw materials combined. So if their overall input costs increase or decrease, or maybe their output changes relative to those costs, this single TFP number would reflect that broader efficiency shift. It's a quick snapshot of their comprehensive resource use.
That's a fantastic breakdown. It really shows the power of those ratios to quickly grasp efficiency, both overall and for specific parts. But as you said, it's not just about looking outside. You mentioned internal benchmarking too. How does that work? And what kind of tools do companies use for that? Is it just comparing spreadsheets between departments?
Yes. Internal benchmarking is equally vital, sometimes even more so because you have more control over implementing changes. The goal here is essentially to find the best processes available within your own organization to complete work with the minimal amount of resources and effort. This involves making comparisons of metrics, yes, but also comparing practices across different units, product lines, departments, programs, or even different geographic locations within the same organization. It's about learning from your own internal successes and then propagating them across the company. So, for example, if InnovateFlow's smart lighting division has perfected, say, a rapid prototyping process, the smart security division could learn from it and adopt it. Why reinvent the wheel, right? Internal benchmarks often utilize a variety of techniques to find and analyze problems or measure performance. Spreadsheets might be involved, sure, but there are more structured tools. Among the most common quality monitoring and investigative techniques are control charts, Pareto diagrams, and cause and effect, or fishbone diagrams. Let's start with control charts. These are really important tools used in what's called statistical quality control, or SQC. It's basically a graphical tool. You plot actual results maybe by production batch or by a constant time interval, like every hour, against an acceptable range. The chart typically has an upper control limit, a lower control limit, and usually an average or target line running through the middle. Its core purpose is to show visually whether there's a trend toward improved quality conformance or, unfortunately, deteriorating quality conformance. The powerful insight here, I think, is that a control chart helps you spot problems not just when they happen, but often as they start to happen. It's like an early warning system for quality issues. Imagine a control chart tracking defects in InnovateFlow's Smart Hub production line. Let's say management has specified an acceptable defect rate between, say, 5 and 15 defects per batch of 100 hubs, with an average target of 10. You'd see plotted points on the chart for each batch produced. Now, if all the individual batches are within these upper and lower limits, that's generally good news. The process is in control. But the chart also helps you see trends. For example, if the points are consistently below the average line or show a general decline over time, that indicates improving quality. Great. Conversely, a consistent rise, even if still within limits, would suggest deteriorating quality, maybe a machine wearing out or a process drifting. And let's say the last few batches have been consistently around 7 or 8 defects, nice and low. But then one batch suddenly jumps to 11. Now, 11 is still technically within the limits, 5 to 15, but compared to the recent trend, it's an outlier. It's a potential shift, a signal to investigate before it goes out of bounds. It's about understanding the pattern and the process behavior, not just reacting to isolated points that cross a line.
Okay, so control charts help us spot problems or potential problems as they're happening or even as they're starting to happen, like seeing smoke before the fire. What about after we've identified that, okay, we have a recurring issue, maybe several recurring issues? How do we prioritize which problems to tackle first? It sounds like you could get overwhelmed trying to fix everything at once.
That's exactly where Pareto diagrams come in, and they are incredibly powerful for focusing effort effectively. Once you have a handle on the different types of defects or issues occurring, a Pareto diagram is used to determine which quality control issues are most frequent and often demand the greatest attention. It graphically demonstrates the frequency of defects, ordering them from the highest frequency to the lowest. It's essentially a prioritized bar chart. It's famously based on the Pareto principle, often referred to as the 80-20 rule, which suggests in many situations that roughly 80% of the problems come from only 20% of the causes. Or maybe 75% from 30%, the exact numbers vary. The point is, a small number of causes usually account for a large percentage of the problems. So imagine a Pareto chart for InnovateFlow showing different types of software bugs reported in their smart home app over the last month. You might see various types listed: login failures, connectivity drops, device pairing issues, incorrect status updates, slow response times, etc. The chart would show bars for each type, ordered by frequency. And you might clearly see that just 3 of those bug types, let's say, login failures, connectivity drops, and device pairing issues, account for a significant majority, maybe 75%, of all reported bugs. This is incredibly powerful information. It tells your development team that by focusing their limited resources on addressing just those top 3 types of defects, they can potentially eliminate 3/4 of the overall bug reports. The critical insight here is that without a Pareto analysis, companies often waste precious resources firefighting symptoms instead of curing root causes. They spread their efforts thinly across many minor issues, feeling busy but achieving relatively little impact. The aha moment comes when they realize that a small, focused effort on just a few key issues can solve the vast majority of their headaches, freeing up valuable resources for innovation or other improvements.
That makes perfect sense. Focus your energy where it delivers the biggest bang for the buck. Okay? And once we've identified those key problems using the Pareto diagram, what's the next step? How do we figure out why those specific frequent problems are happening?
Right. Once the most frequently recurring and often the most costly defects or problems are identified by the Pareto diagram, the next logical step is often to use a cause and effect diagram. This is often called a fishbone diagram because, well, it looks a bit like the skeleton of a fish. It's used to further analyze those high-priority defects. These diagrams provide a fantastic framework for managers and teams to systematically brainstorm and identify the potential root causes contributing to the occurrence of a specific defect or problem. The visual itself is quite clever and helps structure the thinking. The main problem or effect, let's stick with InnovateFlow, maybe the problem is Smart Hub device freezes is written at the head of the fish, with a main horizontal line forming the spine. Branching off that spine are large bones representing main categories of potential causes. Common categories, especially in manufacturing or tech, often include machinery, things like faulty testing equipment, aging hardware; method used, inconsistent assembly steps, flawed software testing protocols; materials, a batch of substandard components, unreliable third-party software libraries; and manpower, inadequate training for technicians, high workload leading to errors. You might also see environment or measurement as categories. Then, from these large bones, smaller bones branch out, providing more detailed, specific potential reasons within each category. For instance, under machinery, you might find specific reasons like incorrect calibration settings or outdated firmware on testing jigs. Under manpower, you could brainstorm things like lack of adequate supervision during assembly or insufficient training on new components. The diagram helps teams systematically brainstorm and organize all the possible causes, not just the obvious ones. This allows them to pinpoint specific areas for investigation and corrective action rather than just guessing or blaming individuals. It's a very structured, visual, and often collaborative way to dissect a complex problem and get closer to the actual root causes so you can develop effective solutions.
Those are really powerful tools for digging into operational efficiency and quality. Fantastic. But as we touched on earlier, it's not all about traditional financial statements or even internal process improvements. Sometimes the most important insights come from, well, unexpected places. Let's talk more about those fascinating non-financial measures and also the non-GAAP measures. These must be increasingly vital in today's economy, right? Especially for a company like InnovateFlow, which seems to thrive on customer experience and innovation.
They absolutely are. You're right. Companies today are increasingly realizing that a narrow focus solely on traditional financial statements, like the quarterly earnings report, often misses crucial drivers of long-term sustainable success. That's precisely why various non-financial measures are becoming so important for evaluating overall performance. They give you a much more holistic view, often revealing the true health and future potential behind the current financial numbers. One really critical non-financial measure is the customer retention rate, often abbreviated as CRR. This is incredibly important because, frankly, it costs a lot of money to find new customers. You hear different numbers, but it's often far more expensive, maybe 5, 10, even up to 25 times more to acquire a new customer than it is to simply keep an existing one happy. Happy retained customers provide a company with sustainable, predictable business. They generate valuable referrals, free marketing. They often act as brand promoters online or word of mouth. And they offer invaluable feedback that can drive product or service improvements. Losing them is costly in so many ways. The surprising nugget here, maybe, is that a single lost customer costs you not just that one sale they didn't make, but potentially all future sales from that customer, plus any referrals they might have sent your way. It's a silent, compounding killer of long-term revenue growth. The formula for customer retention rate is pretty straightforward. You take the number of total customers you have at the end of the period, let's call that E, subtract the number of new customers you added during that period, N, that gives you the customers who stuck around. Then divide that number by the number of existing customers you had at the start of the period, S. So the formula is ENS. Obviously, the higher this number is, the more customers a company has managed to retain over that period. And the inverse of the customer retention rate is what we call the churn rate. It's simply 1 minus the CRR. So if your retention rate is 90%, your churn rate is 10%. That's the percentage of customers you lost. Let's use an example for InnovateFlow. Imagine they sell smart home device subscriptions. Let's say they had 1,400 subscribers at the beginning of the year. Okay, that's S. They worked hard and added 240 new subscribers during the year. That's N. And by the end of the year, their total subscriber count was 1,500. That's E. To calculate their CRR, we take the 1,500 customers at year-end, E, subtract the 240 new customers, N, which gives us 12,260 retained customers from the original group. Then we divide that 12,260 by the 1,400 customers they started with, S. So 1,500, 240, 1,400 equals 12,260, 1,400, which comes out to 0.90 or 90%. This means InnovateFlow retained 90% of its existing subscribers over the year. Their churn rate was 10%. This also tells you specifically that out of their initial 1,400 customers, 140 of them left during the year. 1,400 times that 10% churn rate. That's valuable data to track and understand why they left.
Okay, 90% retention sounds pretty good, but losing 140 customers. Yeah, that highlights the cost you mentioned. So happy customers are absolutely key for sustainability. What about happy employees? I imagine losing staff can be just as costly, maybe even more so, especially for a tech company like InnovateFlow that relies so heavily on specialized talent and knowledge.
You're absolutely right. The employee turnover rate, or ETR, is another critical non-financial measure for exactly that reason. It is very, very costly to lose employees. When someone leaves, InnovateFlow doesn't just lose a person, they lose their specific expertise, the efficiencies they've developed over time, the institutional knowledge they possess. It all walks out the door. And then replacing them involves significant recruitment costs, time, advertising, agency fees, onboarding costs, training, orientation, and inevitably a period of lower productivity for the new hire as they get up to speed. It's a major drain. The surprising insight here, maybe, is that the true cost of employee turnover isn't just the hiring fee. It's often much larger, includes the invisible drain of lost knowledge, the potential dip in team morale, and the time existing employees spend covering the gap or training the new person. It adds up quickly. Now, it's important to add a bit of nuance here. We often differentiate between voluntary turnover, employees choosing to leave, and involuntary turnover, layoffs, terminations. And it's also worth noting that losing people to promotional opportunities within the organization is generally a much better sign than losing them to external competitors. Internal promotions demonstrate clear career paths and can actually boost overall morale and potentially even long-term retention. The basic formula for employee turnover rate is the total number of employees who leave the company within a specific time period, let's call that EL for employees leaving, divided by the average number of employees who worked for the company within that same selected time frame, AE, for average employees. So it's simply ELAE. Let's say, for example, 32 employees leave InnovateFlow over the course of a fiscal year, and the average number of employees who worked there throughout that year was calculated to be 200. The turnover rate would be 32 divided by 200, which equals 0.16 or 16%. Now, whether 16% is high or low depends heavily on the industry, the roles, and the company's specific situation. But a consistently high turnover rate compared to peers can definitely signal underlying issues. Things like problems with company culture, poor management, inadequate compensation or benefits, excessive workload. Tracking this metric helps identify potential problems before they become crises. A low rate, conversely, often indicates a stable, satisfied workforce. Another important efficiency measure, especially for any production or even service-oriented company, is the labor productivity rate, or LPR. This is pretty straightforward. It's equal to the total output of a company, units produced, services delivered, etc., divided by the total number of hours worked to achieve that output. A higher ratio here is generally better, obviously, as it implies greater productivity, more output relative to the amount of effort or labor hours contributed by employees. The LPR formula is simply output, O divided by hours worked, HW. OHW. For example, let's say Innovate Flow's factory produces 5,200 smart sensors in a week, and the total number of hours worked by production staff during that week was 1,300 hours. Their labor productivity rate is 5,200 units divided by 1,300 hours, which is a 4.1 ratio, or simply 4. This means, on average, for every hour worked by the production team, 4 smart sensor units are produced. What's useful about this, beyond just tracking historical performance, is its potential for forward-looking application. If workers are generally able to maintain that same level of productivity, a rate of 4 units per hour, and the company projects needing 1,400 hours of labor next month, you can reasonably project that they will be able to produce around 5,600 units of product, 1,400 hours, 4 units hour. It's a direct, tangible measure of labor efficiency that aids in planning. And finally, just one more non-financial example, particularly relevant in customer service, especially for a company like Innovate Flow that interacts directly with its users. Ticket response time. This non-financial measure represents the total time elapsed between a customer initiating a support ticket, maybe via email, web form, app, and a support agent first responding to acknowledge or address it. The goal, of course, is almost always to consistently reduce this amount of time. Shorter response times generally lead to higher customer satisfaction. It also has a direct link to operational efficiency within the support team. Faster response times often mean happier customer and more efficient use of support staff resources. For instance, let's say Innovate Flow's customer support department receives 120 support tickets in February, and their calculated average response time per ticket is 4.5 hours. Now, maybe they implement some new processes or tools, and by May, even though they receive more tickets, say 150 tickets, they manage to achieve an average response time of only 3.5 hours per ticket. That's a significant improvement. Reducing the average response time by 1 full hour, from 4.5 down to 3.5, represents a reduction of over 20%. This clearly demonstrates operational improvement and a stronger commitment to customer service, even though that specific number won't directly appear on the income statement. It's a powerful leading indicator of customer centricity and potential future loyalty.
Those non-financial measures are incredibly insightful. Wow. They really do reveal the underlying health and maybe the future trajectory of a business in ways the standard financials might not. But what about when those traditional GAAP financial measures themselves don't quite tell the whole story? Maybe they're too noisy or include things that aren't core to the business. Are there ways companies adjust those numbers to get a clearer picture of their true ongoing performance? It feels like peeling back layers of an onion sometimes.
Yes, absolutely. And that brings us neatly to non-GAAP measures. These measures are derived by taking standard GAAP measures like net income or operating cash flow and then adjusting them in specific ways. The companies argue these adjustments provide a better reflection of their ongoing performance or their core operational efficiency. They often aim to strip out what management considers noise, things like one-time events, a big restructuring charge, a gain from selling a factory, certain non-cash charges like stock-based compensation or amortization of acquired intangibles, or maybe the effects of financing decisions. The idea is to remove factors that might obscure the true picture of how the core business is actually performing day to day. The surprising insight here, perhaps, is that sometimes the most accurate picture of a company's underlying financial health isn't found in the big headline numbers reported under GAAP, but rather hidden away in the footnotes and adjusted figures, where the real operational engine is revealed. Though you always need to understand why the adjustments are being made. A very common example you'll see everywhere is EBITDA. That stands for earnings before interest, taxes, depreciation, and amortization. The idea behind using EBITDA is to evaluate a company's pure operating performance by removing factors that might differ significantly between companies for reasons unrelated to their core operations. Things like how a company finances itself, which impacts interest expense, its effective tax rate, taxes, and its accounting policies for long-lived assets, depreciation and amortization, can vary widely. So removing them theoretically allows for a more apples-to-apples comparison of operational profitability between different companies or over time for the same company. It helps investors and analysts see how well a company is generating earnings from its actual business activities before all those other factors come into play. Another key non-GAAP measure, often considered very important by investors, is free cash flow, or FCF. This is a powerful metric because it represents the actual cash a company generates after taking into consideration the cash outflows that are necessary to support its ongoing operations and maintain its capital assets, like machinery, buildings, technology. It's essentially the cash that's truly free and available to the company after paying its bills and reinvesting enough to keep the business running. It's typically calculated by taking net cash flow from operating activities, from the cash flow statement, and subtracting capital expenditures, CapEx. Free cash flow is incredibly important because it shows how much cash a company has available for things like paying down debt, issuing dividends to shareholders, buying back its own stock, or making acquisitions and investing in new growth opportunities. It's a real measure of financial flexibility and the capacity for future growth. Then there are measures like core earnings. The name kind of gives it away. These are the profits derived solely from a company's main or principal business activities. The purpose here is to disregard one-time revenues or costs that are not part of the company's regular ongoing operations and are unlikely to recur. Think maybe a large gain from selling off a division or a big loss from a natural disaster. Stripping these out provides a clearer view of the underlying sustainable profitability that you might reasonably expect the company to generate moving forward. And very similarly, there's the concept of adjusted net income for non-recurring expenses. This measure takes the standard GAAP net income, the bottom line, and adjusts it by removing specific non-recurring expenses, or sometimes revenues, that are not expected to impact the income statement in future years. Again, think of large one-off items, maybe a significant legal settlement charge, or costs related to a major restructuring event. By removing these unusual items, you get a more normalized view of profitability that's potentially more indicative of future performance, helping you compare performance across different periods more accurately without the distortion of those one-time events.
Okay, that makes sense. Using non-GAAP helps filter out the noise. Now, how do companies like our InnovateFlow put all this together? We've talked about financial measures, non-financials, internal benchmarks, external ones, GAAP, non-GAAP. It's a lot. It can't just be about tracking individual metrics in isolation. All right, it feels like there needs to be a way to create a holistic view that aligns everything with the overall strategy. This is where things like financial scorecards and especially balanced scorecards come in, providing that structured approach to accountability and strategic oversight. It sounds almost like creating the grand master plan for a company's performance.
Indeed, you're right. It's about bringing it all together. Financial scorecards as a starting point can take many forms. They might be simple budget versus actual comparisons for a department, detailed variance reports analyzing why costs were higher or lower than planned, or more complex overall analyses of business performance across different segments. Ultimately, a company's overall financial performance is often a direct function of key organizational decisions and the specific performance objectives given to each segment or unit of the business. To manage this effectively, companies often organize themselves into distinct responsibility segments, which are sometimes also called strategic business units or SBUs. These units are typically classified by one of four common financial measures or performance objectives for which their managers are primarily held accountable. Using SBUs is a highly effective way to organize performance requirements and, crucially, to establish clear financial responsibility and accountability throughout the organization. The four common types of responsibility segments, or SBUs, are: first, you have a cost SBU. Here, the managers are primarily held responsible for controlling costs. Their performance is judged mainly on how well they manage expenses within their area, focusing heavily on efficiency and staying within budget. Think of maybe a manufacturing plant or an IT support department. Then there's a revenue SBU. In this type of unit, managers are held responsible primarily for generating revenues. Their focus is squarely on sales targets, market share, and increasing those top-line figures. A regional sales office might be structured this way. Next, you have a profit SBU. This is a more comprehensive segment where managers are held responsible for producing a target profit. This means they have accountability for both revenues and costs within their unit. They need to manage both sides of the equation to hit their profit goal. A product division could be a profit SBU. And finally, the broadest category is an investment SBU. Managers here are held responsible not just for profit, but for the return on the assets invested to produce the earnings generated by their SBU. They have control over investments in assets, like building a new factory or acquiring new technology, and asset utilization, in addition to managing revenues and costs. An entire subsidiary or a major geographical division might operate as an investment SBU. Now, within these strategic business units, especially the profit and investment ones, the effectiveness of their financial scorecards can be further enhanced by subdividing accountability into additional areas. This allows for even deeper insight into where performance is coming from or where problems might lie. One common way to subdivide is by product lines. Many SBUs manage multiple products or services. By analyzing the costs, sales, profits, or even returns associated with each individual product, management can gain much better insight into the specific sources of profits or, critically, losses within that SBU. This helps in making much more informed decisions about things like product development focus, pricing strategies, marketing or resource allocation, or even deciding to discontinue certain underperforming products. Second, you can segment by geographic areas. If an SBU operates across different regions, states, or countries, performance can be traced and analyzed by geographic location. This provides additional insight into regional results, allowing management to understand localized successes or challenges, identify market differences, and perhaps tailor strategies or resource allocation accordingly. And third, often a very significant segment classification is by customer, especially in B2B environments or where a few large customers dominate. Analyzing the relative profitability or even losses associated with any one major customer can profoundly influence management's decisions. For example, if a particular large customer generates significant losses because they demand extremely high levels of service or have negotiated very low prices, management needs that visibility. They might then decide to either try and renegotiate terms, reduce service levels if possible, or in some cases even strategically fire that customer if the relationship isn't beneficial overall, perhaps considering only the marginal benefits versus marginal costs. It's about ensuring every major customer relationship is strategically sound and profitable.
Okay, so it's about breaking down the business into these manageable units, cost, revenue, profit, investment, and then drilling down further by product, geography, or customer to really understand profitability at each level. That brings us to contribution reporting. You mentioned this earlier. How does that work specifically, and what unique insights does it offer, especially for those profit SBUs?
Right. Contribution reporting is a crucial tool, particularly for those profit SBUs, because remember, they are typically responsible for generating a certain level of profit in relation to the costs they can actually control. Contribution reporting formats are specifically designed to clearly show the degree to which the profit that these strategic business units have generated has covered their variable costs and, importantly, their controllable fixed costs. It achieves this by clearly distinguishing between the costs that an SBU manager can influence and those they cannot. The surprising insight here, perhaps, is that what managers can actually control is often very different from what the final bottom line for their unit might say after corporate allocations. Contribution reporting sheds critical light on that difference, making performance evaluation fairer and more motivating. A core concept in this type of reporting is the contribution margin. You calculate this first. It measures the excess of revenues over variable costs. Variable costs are those that change directly with the level of output, like raw materials or direct labor. The contribution margin essentially tells you how much revenue is left over after covering the direct costs of producing whatever was sold. This leftover amount is what contributes towards covering all the fixed costs and hopefully generating an overall profit. Now, a refinement of the contribution margin is the controllable margin. This takes it a step further. It represents the difference between the contribution margin, which we just calculated, and controllable fixed costs. It's important to understand what controllable fixed costs are. These are fixed costs, meaning they don't change directly with output volume, that the SBU managers can significantly influence in less than 1 year. Think about things like the advertising budget specifically for their SBU, sales promotion expenses they decide on, maybe some local administrative salaries they manage. So the controllable margin therefore shows the profit that the SBU manager is truly accountable for, as it represents the contribution margin minus only those fixed costs they have direct control over. Speaking of costs managers cannot influence, we also have the issue of allocation of common costs. Managers typically have control over their variable costs and their controllable fixed costs. That's what goes into the controllable margin. However, there are usually other costs, often called common costs or corporate overhead things like the CEO's salary, the central IT department, corporate legal, headquarters rent that are not controllable by individual SBU managers. For financial scorecards that use contribution reporting to be effective tools for motivation and fair evaluation, the approaches used for the rational allocation of these central administrative costs down to the SBUs must be clearly understood by the responsible managers. And, most importantly, these allocation methods must be perceived as fair and logical. Nothing demotivates a manager faster than feeling like their unit is being unfairly burdened with allocated costs they have absolutely no control over. It's a bit like splitting a dinner bill among friends. Everyone wants to feel they paid their fair share based on what they consumed, not get stuck with a huge chunk of the cost for someone else's expensive lobster, right? Fairness in allocation is key.
That really helps clarify the different layers of cost and control. But this still seems a bit abstract without seeing it laid out. Can you walk us through a practical example? Maybe how a company like, say, Delta Manufacturing uses this contribution reporting approach in their actual performance evaluation reports.
Of course. A concrete example makes it much clearer. Let's look at Delta Manufacturing. Imagine they have 4 distinct regions, and each of these regions is organized and managed as a Profit Strategic Business Unit, Profit SBU. Delta's senior management has designed a specific financial performance evaluation report that focuses heavily on contribution margin and controllable margins. This allows them to assess each region's performance fairly, see where profit is truly being generated operationally, identify areas needing improvement, and understand how each region contributes to the overall company profit before corporate overheads are factored in. Okay, so picture a report, maybe a table, summarizing the performance across these 4 regions for a given period. It would typically start at the top with revenues generated by each region, pretty standard. Then, right below that, it would subtract the variable costs incurred by each region, costs of goods sold, variable selling expenses, etc., to arrive at the contribution margin for each region. This first key subtotal tells management how much each region is contributing simply to covering the company's total fixed costs and generating profit, based purely on their sales and direct costs. You might see, for example, that Region 4 has the highest contribution margin, indicating strong sales relative to its direct variable costs. Next, from that contribution margin, the report would subtract the controllable fixed costs. Remember, these are the fixed costs that the regional managers can directly influence, maybe their regional advertising spend, their local sales team salaries and travel, etc. This calculation leads to the controllable margin. This is arguably the most crucial profit figure from the perspective of evaluating the regional manager's performance, because it isolates the profit that results directly from their decisions regarding revenues and the costs they personally can control. Looking at this line, you might again see Region 4 standing out, suggesting not only strong sales but also effective management of the costs within their direct control. Or maybe Region 2 has a decent contribution margin, but a poor controllable margin, indicating they're spending too much on things they manage locally. The report then typically accounts for non-controllable fixed costs. These are fixed costs that are directly traceable to a specific region, like the rent for that region's main office, or depreciation on equipment located there, but which the regional manager generally cannot influence in the short term. Again, the lease was signed by corporate years ago. After subtracting these traceable but non-controllable fixed costs, you arrive at the contribution by SBU, or contribution by region in this case. This represents the profit each SBU generates before considering any company-wide untraceable overhead costs. And finally, the report would likely show the total contribution by SBU for all regions combined and then subtract the untraceable costs. These are those common corporate costs we talked about, central administrative expenses like corporate IT, HR, finance department costs, the CEO's office, etc., that cannot be easily or logically traced directly to any specific SBU. Subtracting these untraceable costs from the total SBU contribution arrives at the company's overall operating income for the period. What management gains from this detailed breakdown is immense. They can see not just the final company-wide operating income, but exactly how each region operating as a profit SBU contributes, or doesn't contribute, to that final number at various levels of cost control. They can pinpoint regions with strong controllable margins, investigate why others might be lagging, identify if non-controllable fixed costs seem disproportionately high in one area, perhaps suggesting poor asset utilization even if the manager can't control it directly, or even see if a region's revenue isn't adequately covering even its basic variable costs. It helps them analyze performance at a very granular, actionable level, showing clearly who's driving the operational bus effectively and how well.
That detailed financial scorecard, especially using contribution margin, really carves up the profitability picture nicely, makes accountability much clearer. But as we've discussed, to truly understand strategic performance, especially for a forward-thinking company like InnovateFlow, with potentially ambitious goals beyond just short-term profit, companies often need to look beyond just the financial numbers, even the nicely segmented ones. This is where the balanced scorecard comes in, isn't it? It sounds like this is the tool that truly attempts to tie everything together into a kind of strategic GPS for the company.
It absolutely does, and your analogy of a strategic GPS is perfect. That's a great way to think about it. The Balanced Scorecard is a highly effective strategic performance management tool that gathers information on multiple dimensions of an organization's performance, not just financial. It's designed to define and measure the organization's progress against its critical success factors, often abbreviated as CSFs. These are the handful of things that are absolutely necessary for the firm to accomplish its overall strategy successfully. So it gives you a much more holistic, forward-looking, strategic view compared to just financials alone. The surprising insight here, building on your GPS idea, is that the balanced scorecard ensures you're not just driving fast, hitting financial targets, but that you're actually driving in the right direction, achieving strategic goals across all key areas, and importantly, that everyone in the car understands the map and the destination. It forces a company to explicitly define what success looks like beyond just the bottom line. These critical success factors are typically classified or grouped into 4 distinct perspectives or dimensions that provide that balance. 1. The financial perspective. This looks at the traditional measures of success like profitability or revenue growth, return on investment, and overall shareholder value. It essentially asks the question, to succeed financially, how should we appear to our shareholders? 2. The internal business processes perspective. This focuses on the operational excellence, efficiency, and quality of the key internal processes that deliver value to customers. It asks, to satisfy our shareholders and customers, what business processes must we excel at? 3. The customer satisfaction perspective. This examines how the company is perceived by and serves its customers. Key factors might include satisfaction levels, market share, retention rates, and brand image. It asks, to achieve our vision, how should we appear to our customers? 4. And the advancement of innovation and human resource development perspective, often shortened to learning and growth. This looks at the organization's ability to innovate, improve, learn, and develop its people and systems for the future. It considers things like employee skills, morale, access to information, and the climate for innovation. It asks, to achieve our vision, how will we sustain our ability to change and improve? Quote, quote. A well-constructed balanced scorecard typically describes these classifications of critical success factors, the specific strategic goals aligned with each CSF, the concrete tactics or initiatives the company will employ to achieve those goals, and importantly, the related measures or metrics used to track progress towards each goal. It essentially creates a strategic map for the entire organization, visually connecting daily actions and operational improvements to the long-term strategic vision across these 4 balanced perspectives.
Okay, conceptually, that makes a lot of sense, balancing financials with customers, internal processes, and future growth. But how does a company actually build one of these in practice? Let's take an example again, maybe Instafab manufacturing. Imagine they're building their entire business using a cost leadership strategy they want to be the cheapest provider. How would they design a balanced scorecard specifically to guide that strategy?
Great question. A strategy like cost leadership provides a very clear focus for the balanced scorecard. For Instafab Manufacturing, whose core strategy is indeed cost leadership, aiming to be the lowest cost producer in their market to support low prices, their balanced scorecard would be specifically tailored to reinforce and measure progress towards that specific goal. Let's say they've identified 4 overarching strategic goals, one neatly fitting into each of the critical success factor classifications we just discussed. 1. Financial goal, capturing additional market share, often enabled by low prices. 2. Internal process goal, maintaining low costs that are supported by low prices, the core of the strategy. 3. Customer goal, becoming a low price leader, how customers perceive them. 4. Learning and growth goal, linking strategy with reward and recognition for employees, getting everyone focused on cost. Now let's walk through how they might structure their scorecard around these goals, detailing the CSF, tactics, and measures for each perspective. First, let's look at the financial perspective. Their strategic goal here, driven by low prices, is capturing additional market share.
Hey.
A critical success factor, CSF, tied to this goal would be to maintain customer base. Why? Because retaining existing customers is key to growing market share sustainably and, importantly, cost-effectively, rather than constantly chasing expensive new ones. The tactics that employ to achieve this might be, perhaps somewhat counterintuitively for a cost leader, to steadily expand services just enough to keep customers loyal and make switching less attractive without adding excessive cost. And the measures they'd use to track progress on this financial goal, they'd likely look at their company growth rate versus industry growth rate, track a sales volume trend line to see if volume is consistently increasing, reflecting market share gains, and maybe monitor the percentage of sales from new products or services to ensure their service expansion tactic is actually contributing to growth and retention. Next, let's move to the internal business processes perspective. This is absolutely crucial for cost leadership. Their strategic goal here is explicitly maintaining low costs that are supported by low prices. This is the operational engine of their strategy. A critical success factor would be to maintain consistent, efficient production. Why? Because inconsistency breeds waste, rework, downtime, and ultimately drives up costs. Smooth, predictable operations are key. Tactics would likely include things like improving distribution efficiency to reduce logistics costs, constantly streamlining production workflows, and perhaps investing in automation where it lowers long-term costs. Measures would absolutely include their costs compared to key competitors. Are they truly lower? Tracking first-pass yield rates, meaning products are made correctly the first time, significantly reducing expensive rework and scrap costs. And monitoring the percentage of perfect orders delivered. Getting orders right the first time reduces returns, service calls, and administrative costs. Third, we have the customer perspective. How do customers see InstaFab? Their strategic goal is clear, becoming a low-price leader. This is the value proposition they offer and what customers primarily expect from them. Their strategic goal is clear. A critical success factor supporting this might be to anticipate customer needs before competitors. How does this help cost leadership? If they can accurately forecast demand shifts or emerging needs, they can optimize production runs, manage inventory more efficiently, reducing holding costs, and maintain lower overall costs by avoiding expensive last-minute rushes or stockouts. Their strategic goal is clear. Tactics would naturally focus on increasing customer satisfaction, but specifically related to price and reliability. Even with low prices, basic satisfaction drives repeat business and reduces costly complaints or support interactions. Their strategic goal is clear. Measures for this perspective would likely include tracking our delivered cost versus competition to confirm their price advantage in the market, maybe the percentage of products currently in R&D that are being actively test marketed, showing their proactive approach to understanding and preparing for future customer needs efficiently, and conducting regular customer surveys specifically gauging satisfaction with their pricing, value, and order fulfillment reliability. And finally, the advanced learning and innovation, or human resources learning and growth perspective. How do they sustain this cost leadership? Their strategic goal here is linking strategy with reward and recognition. To be a successful low-cost leader consistently, employees at all levels need to be actively thinking about efficiency, continuous improvement, and cost savings in their daily work. The reward system must reinforce this. A key tactic would be to promote an entrepreneurial, cost-conscious culture where employees feel empowered and are encouraged to identify and implement efficiencies and process improvements. Measures could include things like net income generated per dollar of variable pay or bonus paid out, which directly links compensation to overall profitability and cost control effectiveness. They might also track metrics from annual employee surveys related to engagement, empowerment, and understanding of the cost leadership strategy, showing how well the desired culture is taking hold. So, what this comprehensive balanced scorecard does for InstaFab is create that powerful strategic map we talked about. It connects actions at every level of the organization across all these different but interconnected business aspects directly back to the overarching strategic goal of cost leadership. It ensures that even non-financial activities like process improvement or employee training are strategically aligned and measured for their contribution towards that core objective. It really does function like a strategic compass, keeping everyone pointed in the same cost-focused direction.
That's incredibly thorough. You can really see how it forces a company to think about how everything connects to this strategy. It's not just a dashboard of random metrics. Okay, for our final segment, let's talk about something that often gets overlooked, maybe feels a bit abstract, but you mentioned it earlier, and it sounds absolutely critical to long-term performance, the cost of quality. You framed it as not just about what you spend, but maybe more importantly, what you don't spend when things inevitably go wrong. Tell us more about that.
Exactly. It's a crucial concept. First, let's quickly define quality in this business context. It's broadly defined by the marketplace, by your customers, as a product's ability to meet or ideally exceed their expectations. Does it do what it's supposed to do, reliably and effectively? Then, the cost of quality is a term that encompasses all the costs associated with activities related to ensuring conformance with those quality standards, as well as the opportunity costs and activities associated with correcting nonconformance with quality standards. So it's both the proactive investment in getting things right the first time and the often much larger, reactive, and sometimes hidden expense of fixing things when they go wrong. The surprising truth here, and it's a big one, is that quality shouldn't be viewed as just a cost center on the budget. It's actually a strategic investment that generates tangible returns. Every dollar wisely spent on preventing defects can often save you many, many more dollars in future failures, rework, warranty claims, and lost customers. These costs of quality typically break down into two main types: conformance costs, the good costs, and non-conformance costs, the bad costs. Let's start with conformance costs. Paying to get it right. These are the proactive costs you intentionally incur to ensure your products or services meet the required quality standards before problems occur. Think of these as investments spent upfront to prevent defects from ever happening or to catch them early. They are further classified into two subcategories. First, there are prevention costs. As the name suggests, these are costs incurred specifically to prevent the production of defective units in the first place. It's about building quality into the design and the process from the very start. Examples include things like employee training on quality procedures and skills development, making sure staff know how to do the job right, inspection expenses for raw materials coming in, rigorously checking materials and components before they even enter your production process to avoid introducing flaws, preventative maintenance on machinery and equipment, keeping everything running smoothly and accurately to avoid breakdowns that cause defects. Redesign of products or processes specifically to make them inherently more robust, easier to manufacture correctly, or less prone to errors. Actively searching for and qualifying higher quality suppliers, even if they cost a bit more upfront to ensure more reliable inputs. The second type of conformance cost is appraisal costs. These are costs incurred to discover and remove defective parts or products before they are shipped to the final customer or even passed along to the next department in the production line. It's about checking, testing, and verifying quality as you go. Examples include using statistical quality checks, like those control charts we discussed, to monitor processes in real time, conducting rigorous testing of products during or after production stages to ensure they meet all specifications, performing final inspection for completed products just before they are packaged and shipped, that last check, the maintenance of the quality control laboratory and its equipment, costs associated with having the facilities and tools to perform these checks accurately.
Okay, so those are the proactive cost prevention and appraisal. Money well spent, it definitely sounds like. Investing up front. But what about when things do inevitably go wrong? Despite those efforts, what are the costs of nonconformance, the bad costs? And you mentioned they can be hard to measure.
Right. When things do go wrong, we incur nonconformance costs, the price of getting it wrong. And yes, these are often much more difficult to compute accurately, partly because many of them are opportunity costs, like the potential future revenue from lost sales due to a damaged reputation, or the intangible costs of brand erosion, which are really hard to put a precise dollar figure on. Nonconformance costs are also classified into two subcategories, depending on where the failure is discovered: internal and external failure costs. First, internal failure costs. These are the costs incurred to cure a defect that is discovered before the product is sent out to the customer. So you catch the problem internally, thankfully, before it leaves your facility and impacts the customer directly. Examples include rework costs, the direct expense, labor, materials, overhead, of fixing a defective product to make it acceptable. Scrap, the total cost of materials, labor, and overhead for products that are so defective they must be discarded entirely, a complete loss. Tooling changes, unexpected adjustments or repairs needed because a tool, jig, or machine is identified as causing defects, costs to dispose. Expenses associated with safely or environmentally disposing of scrapped units. Cost of the lost unit itself. The standard production cost of the unit that couldn't be sold because it was scrapped. Downtime. Lost production time due to having to stop lines to fix defect issues, machine breakdowns caused by quality problems, or sorting bad parts. Second, and often the most severe and financially damaging category, are external failure costs. These are the costs incurred to cure a defect that is discovered after the product has already been sent to the customer. This is the worst-case scenario, as the defect made it out into the market and the customer found it. Examples include warranty costs, the significant expense of honoring guarantees for faulty products, including the cost of replacement parts, repair labor, and shipping, cost of returning the good, logistics, shipping, and handling expenses for bringing defective items back from customers, liability claims, potentially huge legal costs, settlements, and judgments arising from product failures that cause harm, damage, or injury, liability claims, crucially and often underestimated, lost customers. This is an immense opportunity cost, as we discussed with CRR. Once a customer has a significantly bad experience, they may never return, and worse, they are likely to share their negative experience widely, online reviews, social media, word of mouth, actively deterring other potential customers. Re-engineering an external failure. The potentially massive cost of having to fundamentally redesign a product or process due to a widespread failure that was only discovered after it reached the market, think major product recalls. It's really these external failure costs, particularly the somewhat intangible costs like lost customers and long-term reputational damage, that are the hardest to fully quantify but can have the most devastating, lasting impact on a business's success and survival. They can erode trust and market share in ways that a simple quarterly income statement doesn't immediately reflect. Now, this all leads us to the critical concept of quality reporting and what's known as the inverse relationship between these different types of quality costs. Companies often produce cost of quality reports specifically designed to display the total financial result of all these quality-related efforts and failures, usually broken down into those four categories: prevention, appraisal, internal failure, external failure. The key strategic takeaway, the core concept revealed by tracking these costs over time, is that an inverse relationship generally exists between conformance costs, the good ones, and non-conformance costs, the bad ones. What this means in practice is that increased investment in conformance costs, that is, spending more proactively on prevention and appraisal efforts, should logically result in significant decreases in non-conformance costs, meaning fewer internal failures, less scrap, less rework, and crucially, fewer external failures. Fewer returns, fewer warranty claims, fewer lost customers. Conversely, if a company tries to cut corners and reduce its investment in conformance costs, slashing training budgets, skipping inspections, delaying maintenance, they will very likely see a significant increase in non-conformance costs down the road, often paying much, much more dearly for the failures than they saved up front. It's a fundamental strategic trade-off. Do you spend more upfront to build quality in and save much more down the line? Or do you try to scrimp upfront and inevitably pay dearly, often unpredictably, for failures later? The deep insight, really, is that you inevitably pay for quality one way or another. You can choose to pay for it proactively through conformance investments, or you can be forced to pay for it reactively, often in spades and with compounding interest, through non-conformance failures. The smart money is usually on the proactive approach.
That's a really powerful dynamic, that inverse relationship, the idea that spending more on prevention and appraisal can actually save you significantly more money in the long run by avoiding those failure costs. Can you give us an example, maybe from your sources, where a company truly understood this inverse relationship and made a strategic shift that really paid off dramatically for them?
Yes, there's a perfect example involving a company let's call Glass Products, Inc., GPI. In the past, GPI was really struggling. They were experiencing significant internal failure costs. They faced substantial production downtime because of frequent machine errors related to quality, and they had costly batch rework operations because batches of glass products weren't meeting the required specifications consistently. On top of that, and perhaps more worryingly, they faced considerable external failure costs after shipping their glass products out to customers. They were dealing with high material costs from frequent product returns, handling warranty claims, and crucially, they acknowledged they had lost a number of significant customers specifically due to receiving faulty products. Their poor quality was really hurting them, both financially and in terms of their market reputation. Now, at the beginning of the current operating year, GPI made a key change. They replaced their production manager. The new manager came in with a strong understanding of this critical inverse relationship between conformance and non-conformance costs. It was a core part of their philosophy. So, in his very first week on the job, he took concrete, deliberate steps to increase the company's investment in conformance costs. He hired a dedicated statistical quality technician whose job was specifically to test products using statistical methods as they exited the production line. It's a clear increase in appraisal cost. He then immediately implemented mandatory quarterly employee training programs focused specifically on quality control procedures and techniques and increase in prevention costs. He also significantly enhanced the preventive maintenance schedules and procedures for all the critical production equipment, another prevention cost. And finally, he introduced weekly quality inspection routines to be carried out by the line supervisors themselves, adding another layer of appraisal and reinforcing prevention focus. These were all direct, intentional investments in improving quality up front. The results, even within the first half of that year, were reportedly dramatic. Through these strategic investments in appraisal and prevention, GPI achieved an incredible 90% reduction in production downtime compared to the previous period. Think of the productivity gain. They also saw a 50% reduction in the company's costly scrap costs. These are direct, measurable savings in internal failure costs. But even more importantly, as a direct consequence of these proactive prevention and appraisal measures catching issues earlier or preventing them entirely, the company experienced significantly fewer glass product returns from customers. And crucially, management reported that they lost no existing customers due to quality issues in the current operating year, a stark contrast to the previous situation. That last part, zero lost customers, is huge, as retaining those relationships is invaluable for long-term stability and growth. This powerful example from GPI clearly shows how investing proactively and strategically in quality by deliberately increasing those conformance costs prevention, and appraisal can directly lead to significant bottom-line savings and far better overall business outcomes. It works by drastically reducing those much more expensive non-conformance costs, both internal and external failures, and perhaps most importantly in the long run, by preserving and even enhancing crucial customer loyalty and the company's reputation in the marketplace. It's a clear, real-world demonstration that quality isn't just an unavoidable expense line item, it's a strategic investment that yields tangible financial and significant reputational returns when managed intelligently.
Wow. Okay, today we've really journeyed through the intricate, honestly fascinating world of performance management. We've seen how seemingly disparate measures, financial, non-financial, internal benchmarks, external comparisons, quality costs, actually connect to form a larger strategic picture.
That's right. Effective performance management isn't just about collecting data points or filling out reports. It's really about building a dynamic, interconnected system. A system where clear feedback drives the right behaviors, where incentives are properly aligned with strategic goals, and where a holistic, balanced view guides the entire organization toward its objectives. It's fundamentally about continuous learning, adapting, and improving based on what the data in its entirety is telling you.
So what does this all mean for you listening in? We've gone from the big picture of understanding motivation and linking it to feedback, right down to the nitty-gritty of calculating total factor productivity ratios. We've explored how tools like control charts and Pareto diagrams can help you focus your efforts on what really matters in operations. We saw how strategically aligning an entire company using a balanced scorecard provides that crucial GPS for navigating towards success. And we've just uncovered how investing in quality up front through those conformance costs can paradoxically reduce your overall costs significantly by preventing expensive failures and protecting your invaluable brand reputation. We genuinely hope this deep dive has given you a clearer, maybe more insightful lens through which to view how organizations truly succeed or sometimes struggle in measuring what truly matters for long-term health. Now, as you go about your day, here's a final thought to maybe chew on. Consider a company you admire, or perhaps even the one you work for. Based on everything we've discussed today, what performance measures do you think they should be prioritizing right now? Go beyond just the obvious financial ones, like quarterly profit. What non-financial metrics, what process improvements, what customer insights, or what investments in learning and growth might be absolutely critical for ensuring their long-term health and building unwavering customer loyalty in today's world? What's maybe that hidden metric, that key performance indicator they might be overlooking that could truly unlock their next level of sustainable success? It's a fascinating question to ponder, isn't it? Thank you so much for joining us on this deep dive into performance management. Keep that curiosity burning, keep asking those how and why questions, and we'll see you next time.